Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, it feels like a solid month since I've last seen you.
A lifetime. You went to the exchange conference. I mean,
did.
That was another world.
So I was off and then you were off and now we're back together. And we have a lot to talk about in this $12 trillion global ETF industry. We're going to talk about the AI frenzy connected to ETF. Kathy Wood just trimming her stakes in TSMC. Of course, that's a key customer of NVIDIA.
Plus, in just a moment, we'll discuss the big active and passive trends in the ETF world with Amarita Nandakumar. She is president of Vident Asset Management.
And we're also going to talk to David Scranton of the Sound Income Group to look at a fund that guides investors towards a steady income. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. The flows are interesting this week, I got to say. So the Magnificent Seven stocks have just dominated the market for a while now, right? Look at the top three ETFs in weekly flows: VGIT, IWM, and BBEU. That's Treasuries, small caps in Europe. Those haven't really made an appearance in a while. The Mag 7 has just rolled over those trades for months and months, even years. These are model portfolio trades likely. So the models are like, look, Mag 7 overvalued, let's try to get in here. Really betting, hoping, praying for a regime change. We've heard this before. Whether they're right this time, time will tell. Also money into IBIT, the Bitcoin ETF. And EMXC, interesting. That's Emerging Markets ex-China. That was the most popular emerging markets ETFs last year. Now has a leveraged version of it as well. Let's look at the outflows. And the outflows tell the same story. At the top of the list, you see SPY and the Qs and QQQM, which is the cheaper version of Qs. Those all are basically market cap weighted, Mag 7 heavy ETFs. So clearly there's a trend here. Also, look at GLD. We talked about this in a note BI did yesterday, or this morning rather, about how gold ETFs are seeing outflows as the Bitcoin ETFs see inflows. This is like a cherry on top for the Bitcoin crowd, who they do not like gold. So they're getting a little bit of extra excitement there with gold seeing outflows. Speaking of excitement, NVIDIA obviously is a big deal. So I thought, let's look at an area really impacted by NVIDIA, and that would be AI and robotics ETFs. A lot of these ETFs have a large weighting in NVIDIA, and this is one of the interesting charts I've ever seen. Normally with thematic ETFs, they have a performance run, everybody piles in, then the performance goes down and they leave, right? It's hard to get a second bite at the apple, but these did. They got a third bite at the apple. So here you have the NVIDIA sort of wave, a third wave into AI and robotics. This area, interesting, if you get 3 bites at the apple and you see a chart like this, that's a good sign for staying power. So NVIDIA, you're just having effects all over the place.
Effects all over the place. Well, let's keep this conversation going now with Amarita Nandakumar. She is president of Vident Asset Management. And sort of on the topic of thematic ETFs, I thought this line in your notes was really interesting, that it's no longer enough to have an interesting investment strategy or even strong performance. That doesn't necessarily beget flows in this environment. So, I mean, if I'm an issuer here and I have a really interesting thematic idea, what do I do with that?
First of all, it's great to be back. Thanks for having me. Whether it's thematic or really any other ETF, I think as an issuer, you need to start with, why am I launching this, right? What is my differentiated value proposition? What do I bring to the marketplace? And how does this address investors' needs and address investors' goals? Right? And then I need to figure out, who am I going to target this to and how am I going to reach that audience by investing aggressively in sales and marketing resources. And you don't have to necessarily have the scale of a BlackRock or a Vanguard in order to get your message out. From what we see with the number of issuers that we work with at Vident, it's really about knowing who you're targeting and being very thoughtful and deliberate about how you're going to reach them.
So it sounds like going niche can play out and pay off as long as you know exactly how you're going to go about it. How do you take that niche and scale it?
So I think along with starting with your target audience, you do need to be out there constantly educating, constantly telling your story. It's not enough to assume that investors are just going to arrive at your website, that they've been waiting for you to show up. I think it's incumbent on you as the expert, as the issuer, to tell your story and explain to investors why your fund is a can't miss.
Well, I mean, with that in mind, we obviously have seen so many launches, record ETF launches, a lot of them from these smaller issuers. And I mean, looking ahead, where it sounds like you're going to have to be spending more on marketing, like you said, you're going to have to be out there really promoting your product. Would you expect more consolidation in the ETF industry as some of these smaller issuers try and fail to get to scale?
We have seen some of that in the last few years, but to be honest, I think most issuers, if they are going to fail, they tend to fail quickly. So there actually may not be enough time for potential acquirers to really get out there and get those ETFs on their platform. I think there's also something to be said about if the original issuer couldn't do it, what could a new provider come in, what difference could they make? Now, if they had a huge distribution platform, if they had very well-established distribution capabilities, that might be one thing, but if it's just a, well, I guess we'll take a shot and see how it goes, we're just not seeing a lot of that.
Speaking of distribution, active ETFs, you have in your notes, obviously we look at it. This year, active ETFs have taken in $30 billion, about half of all the money. Big deal, right? 50%, they only make up 7% of the assets. They're punching above their weight. But if you look at which ones are, it's like JEPQ, BINC, DYNF, AVUV. A lot of these are smart beta, money coming from mutual funds, or in JEPQ, it's a covered call strategy. This active rise is definitely happening, but it's not exactly the return of the genius stock picker person, is it?
No, I think it's about financial advisors in particular that are looking for solutions, right? And especially in a rapidly changing environment, they're busy building up their books, trying to gather assets. They're looking to issuers to come in and solve the problems for them, to tell them where to be. And smart beta has historically marketed itself as just a little quote unquote smarter than the average market. And so for a financial advisor, that may be a good place to start, especially where they may not have a ton of conviction at the moment.
How much do fees matter in active equity ETFs versus passive? Because it's paramount in the passive world, but does it matter? Is it number one or number two in terms of priority for active?
I would say it is certainly up there in the top three. It's just as we saw in passive, it's starting to matter more and more. Maybe didn't matter as much in the early days, but now as there's a plethora of product, there's a lot of issuers out there telling their stories, and some of those funds are actually performing well. The costs do make their way into that equation.
And so it's interesting. I mean, when it comes to active, I found a hopeful note in your notes there that you look at this boom that we've had. Maybe you're thinking, maybe it's too late for me to launch my strategy. But even with this tough environment that we've been talking about, there's still hope there.
I believe that. I believe that, and we see that every day at Vident with the number of issuers that we work with. The folks that really take the time to understand, to really establish and articulate their identity and explain to investors what makes them different from what else is out there. And again, as we were talking about earlier, just being very specific about who you're reaching out to and understanding why you're reaching out to them. I do believe that you don't need a multi-million-dollar marketing budget. If you're really smart about how you deploy your resources, you can be out there telling your story very successfully.
Speaking of stories and speaking of hope, let's go to hopeless. Okay, every time you're on, we debate ESG ETFs. Are you ready to sort of declare them over? They have seen not ESG data, but ESG ETFs. They've seen a lot of outflows. Nobody talks about them much anymore. Bitcoin's kind of the new kid on the block. What's your take on that? BlackRock transitioned away a little bit into the Bitcoin area. What do you think?
It has become quite a hot button issue, right? Not just in our industry, but certainly politically and elsewhere. And so I think issuers have just followed suit. And so they've been dropping ESG from their names, dropping certain keywords that they might think could cause some controversy or might cause somebody to not want to invest in their product. So the issuers that have remained in the market, you'll see they've slowly transitioned to sustainable in lieu of ESG. I think that there's always going to be a market for those funds, but certainly, we've seen the launches trickle to nearly zero. I think that's going to continue for a while until maybe the social and political tide changes.
You knew Eric was going to come in hot. With
I knew it was coming. I was ready for it. I was ready.
All right. Well, Amarita, it's always great to see you, of course. That is Amarita Nandakumar of Vident Asset Management. Now, we do want to turn now to some breaking news crossing the wire just a couple of minutes ago, and that is that the FTC sued to block Kroger's $24.6 billion acquisition of Albertsons, arguing that the tie-up would lead to lower wages for workers and higher prices for groceries. Bloomberg's Sarah Forden joins us now from D.C. And Sarah, taking a look at the route that the FTC is taking here, not necessarily surprising in this case.
Yeah, this suit was widely expected. In fact, we broke the news last week that it was going to be coming as soon as this week. This deal unites the top two supermarket owners in the country. It would bring together labels like Albertsons, Safeway, and Kroger, and Harris Teeter. So a lot of overlap here. The companies say they need it in order to compete better with companies like Amazon and Walmart. but the FTC is not buying that. They also turned away a proposed remedy that the companies offered. They proposed selling 413 stores to another supermarket operator. They didn't think that was viable, and they pointed to a history of failed remedies in the supermarket M&A landscape in the past.
All right, good stuff. Sarah Fordern, thank you so much for joining us, giving us some context here on the headline that 8 states and the FTC, as well as Washington, D.C., have sued to block Kroger's $24.5 billion acquisition of Albertsons today. Now, coming up on ETF IQ, we speak about the ETF tax loophole that uses some old tricks. That's next, and this is Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. We start with Carson Group. This is a $30 billion RIA platform, and I reported out last week that when it comes to the 10 just launched spot Bitcoin ETFs, they've approved 4 of them to trade on their platform. So that includes iShares, Fidelity, Bitwise, and Franklin. Really interesting color here. Of course, whether or not these ETFs get onto platforms of high consequence. Carson Group, one of the first to share details there. Let's also talk about YieldMax and their lineup there of single stocks income strategy ETFs. So that combines 2 crazes, which is single stock ETFs and also covered call strategies. They've combined that successfully to produce almost $2 billion in AUM. And you can see on that chart just how quickly those assets have grown. So quite a boon for YieldMax there. And let's also talk about taxes. Specifically, we're going to talk about Box here, and that's with 2 X's. That is a T-bill ETF from Alpha Architect. So it uses a complex option strategy and also a long-standing tax loophole to produce starkly lower tax bills. Scarlett, I'm not going to pretend to know the nuances of exactly how this one works.
All right, well, let's get the details from the author of this story, Bloomberg's Zach Miter, a Pulitzer Prize-winning investigative reporter here at the company. Zach, always good to see you. So explain how Box works, because it promises returns like Treasury bills, but it's not exactly the same as investing in Treasury bills.
Exactly. They don't own any Treasuries, but they produce returns that are almost the same by a bunch of complicated options trading. But what's interesting is that if you own a T-bill ETF, you have to pay tax every year at relatively high rates on the income, on the earnings of the Treasuries generate. With Box, you get no tax bill until you sell, and even then, potentially a lower rate.
And this is so interesting because I feel like I knew about this ETF. I knew when it launched, but I didn't realize that it had this interesting nuance to it. So an immediate question, of course, that comes up is, why would I go through this ETF? How does this compare to just outright buying T-bills?
Right. Well, the difference, first of all, is it's the government if you buy T-bills. Here, you're hoping that these guys are not making some kind of mistake with the options, and your counterparty is not the U.S. government. It's very highly rated, but it's not the U.S. government. So there's real, potential risks you have to consider there. Plus, the tax treatment, depending on who you are and what state you live in, might be a little more complicated. But generally, it's a big tax advantage for a lot of people.
Tax advantage means it's going to get a lot of eyeballs in Washington, and Congress is taking a look at this. What's the latest on that front?
Right. So Democrats in Congress have made noise in the past about closing the ETF loophole. It's estimated to cost about $20 billion a year. And so people in the ETF world, meanwhile, are just trying to find ways to put new things through the loophole, like Box. And so to the extent they're successful, that could potentially make an even bigger target in Washington.
If that happened, that would be like existential, by the way.
We'd have an ETF IQ special.
I know, exactly. We do an emergency show there. But when it comes to, like you said, ETF issuers trying to fit other things through the loophole, could we see other issuers go with this strategy, or does it only specifically work with T-bills? What have you heard around those lines?
It's hard to know. Definitely there are other people working on similar things, but there's also other things that you could hardly imagine that involve this using the same loophole. Like imagine you had a hedge fund and you turned it into an ETF so you could sell your appreciated positions without a tax bill. that's the kind of thing that people are trying to imagine. You know, we have this like great loophole, like let's try to use it in new and creative ways.
Let's try to use it until someone decides to shut that one down. Zach Miter, thank you so much. Fantastic article in the Bloomberg. And of course, you can check it out on Bloomberg.com. Still ahead on ETF IQ, we drill down into dividends with David Scranton of Sound Income Strategies. Next, this is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we have Divvy, which is a dividend, sound equity dividend income ETF. You know, kind of a vanilla name. You know, there's 200 dividend ETFs, but this is interesting. This ETF only goes after qualified dividends. So qualified dividends are taxed at a much lower rate. Speaking of taxes, the government wanted people to invest in the economy and long term, so it decided to have certain dividends be qualified. So advisors, this is a big deal to them. So this is an actively managed ETF that goes after these stocks. The goal is to double the yield of the S&P with these dividends, as well as make them qualified to lower the tax bill. The fee is 45 bips, pretty good for an active strategy. $27 million. Let's look at the sort of cross-section of what you get. Big thing here is, A, you're getting a lot of active share. This isn't really similar to the S&P at all. It's 96% different, and that means a lot of energy stocks. Energy is a 16% weighting versus 3% in the S&P, and a lot of materials and underweight tech. So overweight energy, underweight tech, you got to be comfortable with that. The PE is 12, so a little lower than the S&P, obviously. So it's got a value tilt to it. Let's look at the performance of this versus the, I don't really know exactly what to compare it to. I put it against the market and against VIG, which is the Vanguard Big Dividend ETF, the biggest one in the world. And you can see it's easily beating the Vanguard one, which is good, and it's beating the S&P. That's a good sign. You can see it's a little more volatile than both because of some of those energy names. So look, good performance, qualified dividends, a lot of value proposition here, Katie.
All right, Eric, thank you. And joining us now to talk about this ETF is David Scranton. He is co-founder of the Sound Income Group. And so when it comes to qualified versus not qualified dividends, I have to admit I've never thought about that distinction. But by focusing on qualified dividends, how much does that limit your potential pool of investments?
It basically just limits us to common stock. And in fact, it's a big part of the reason we started the fund. And it's interesting because we manage billions of dollars of assets and almost all of it's individual securities. I actually have never been a huge ETF fan, but what's interesting is that for our smaller clients, they need ETFs. And I went out and I searched high and low for a high dividend paying common stock value-based fund. And what I found when I looked at the market was that most of these funds had they had REITs in them, or they had MLPs in them, or they had maybe ugly-looking tobacco stocks that people don't really want to own. And when I took all the existing ETFs, the high-dividend ETFs, out of the picture that had those things, our own portfolios were generating a higher dividend payout with competitive returns compared to all the other ETFs that existed. So that's why we decided to launch Divvy, because there was a niche in the marketplace that needed to be filled.
Thank you for explaining that. That's super interesting how you kind of stumbled upon that. With technology companies now paying out dividends, Meta, for example, announcing a dividend, although its dividend yield is 0.4%. Do you anticipate at some point adding tech names and more tech names with the robust free cash flow to your portfolio, even if they're not exactly priced at a discount?
Sure. I mean, it's anything that's value-based. Right now, the problem is you're hard-pressed to find tech names that are value-based. It's all a growth play.
Right.
And this fund is a bottoms-up stock selection. Really, we're looking for hidden value that can come to fruition down the road. And when we get to a point where we can find that in the tech world with a little bit of yield, absolutely.
I do want to talk a little bit more about who this is for. I mean, we were talking about it with Amarita Nandakumar a little bit earlier about how difficult distribution is for some of these upstart funds. What kind of strategy are you pursuing when it comes to getting this on platforms, when it comes to marketing, for example?
Well, it's interesting. Like I said, we initially started it just because we have some clients that are smaller clients that really should be in ETFs. And when we found that we couldn't find anything that's competitive, we said, okay, we're going to start it and we're going to build it. Never really thought about marketing it per se. And then, of course, you start getting close to that 3-year point where you have a 3-year track record and you can actually get onto platforms. So we went out, we brought on regional wholesalers that we've hired on our team to come in, and also professional whose name is well known in the ETF industry when it comes to marketing ETFs. So this is all toward the end of last year. But up until now, we really haven't tried to market it. We are just starting as of January 1st to do that and get it out there. We've already gotten on some big platforms. And by the end of the year, I'm sure we'll be on a lot more.
And David, real quick, about 40 seconds, what have you learned going into the ETF industry? You said you weren't a fan of it. Are you a fan now?
I'm a fan of ETFs where they're needed. And especially when if you have accounts under $250,000, and sometimes it's just hard to cost-effectively diversify with individual securities, and their ETFs are a great niche. And this whole concept of these actively managed ETFs are really a void that I think is starting to get filled finally. And so if you've got somebody where they're retired or close to retirement, they're looking for income, but they don't want to be in all bonds, they still want to have some upside potential, that's where a fund like Divvy really can come in and fill that gap.
And David, to be clear, you're a fan of ETF IQ, correct?
100%, of course I am, every day.
All right, beautiful, beautiful. Well, then you can come back.
You guys are my lunch show.
I love it. I love it. That, of course, is David Scranton of the Sound Income Group. And like David, if you just can't get enough of ETFs, a reminder, you can listen to Eric and Joel Weber on Trillions. Of course, it's their podcast that covers the industry. But sadly, that does it for Bloomberg ETF IQ for now. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.